You're on a business trip in Florida. It's Friday night, about 8:30. You're sitting in a restaurant with some colleagues. Phone buzzes. Text pops in. You don't recognize the number. Claims it's from the FDIC, stating that your bank is in receivership. You chuckle, delete the message thinking, oh yeah, those scammers are getting better, aren't they? You continue eating. 20 minutes goes by. Your wife calls. She's frantic. She's at home on the West Coast looking at her business account, and the 5.3 million she had in there says it's only 250,000. You ask, what? And our family account? Same, the 1 point something million, down to 250,000 also. And both accounts are locked. You're like, what? You step up from the table, start walking away. You check your bank app. Sure enough, your business account is also frozen. And you've got a huge real estate deal next week and all the money's gone. What are you going to do? You look up at the TV in the hotel lobby. They're interviewing a prior FDIC advisor. And she's explaining that deposits above 250,000 are considered unsecured loans to the bank. And you are by law an unsecured creditor to the bank. She reluctantly admits that recovery is uncertain, but she'd estimate that 50% of your deposit is going to be gone, and the other 50% is going to be turned into stock or equity in a new, almost failed bank that the FDIC is going to create over the weekend. You spend the entire weekend with your attorneys and your executive team trying to figure out how you're going to keep your business afloat starting Monday. And something in the back of your head just keeps asking, why didn't somebody on my team explain to me that this could happen? Welcome to the authority given the FDIC under Title II of Dodd Frank. It's just sitting there waiting. You think I'm exaggerating? You think I'm making this up? Listen to this FDIC employee as she sits asking the Systemic Resolution Advisory Committee, aka Liquidation Committee, for advice on how to explain the powers that have been given to the FDIC under Title II of the Dodd Frank Act. Listen to her try to elicit from these advisors how much transparency she should actually be providing the general public. And then as that question continues to ring in the back of your head, why hasn't anybody warned me? You'll understand that this committee meeting, they decided that it would be best not to scare the general public. Only those with a professional need to know can understand these things, even though they're publicly available. They made a conscious decision not to inform the public until the crisis has begun.
What do we want to think about today is what should we be transparent about now that would help improve confidence in the event that we're called to use our Title II authorities. We're thinking about creditors. How do you communicate with claimants? There's a lot of questions here. And so, there are a lot of things we've been thinking about, and what we want to hear from you today is what you think the priorities would be in order to go about setting expectations appropriately in public about how we would execute Title II, so that if and when we do have to have that announcement on Friday night, ideally Friday night, that people are in a position to receive it, understand it, and say, yeah, that works.
Hi, my name's Eric Martineau, and I'm the owner of PrivateEquityBanking.com. Shortly, we'll continue analyzing this FDIC Systemic Resolution Committee meeting, or Liquidation Committee meeting, discussing the FDIC's powers under Title II and the amount of transparency they're willing to share. But the question would be, why now? This took place in 2022. Obviously, I've known about this for many years, and I've shared it with many of my clients. So what gave me the impetus to do this now? The other day I was having a conversation over Zoom with three friends of mine. I was introducing one to the other two, and they're all, now that I think about it, all three of them are self-made millionaires. And I was introducing one to the other two, and I said, this gentleman here helps people get out of debt, and he's written a software package that helps people do that, and it's often combined with high cash value insurance. Now, one of the two gentlemen that I was introducing him to knew that I helped people get out of debt with high cash value insurance policies. And he made a comment that I hear often from those that have money. Well, that's a good product for those that need to get out of debt, but for me, I don't need it. Insinuating I can pay cash for anything, so why would I buy high cash value insurance? One of the things I knew about that gentleman is that he had previously had a high cash value insurance policy and that he had canceled it. And when he canceled it, he and I had chatted about it, and I asked him why he had canceled it, and he kind of got fired up, and he said, well, the gentleman that sold me that policy told me that it was an investment, and it's not an investment. In fact, I think that anybody that's an insurance agent that actually even calls insurance and investment should have their license taken away. And I chuckled and I said, well, lucky for me, you've seen my presentation, and twice during my normal presentation about high cash value insurance, or private equity banking as I call it, I state categorically I do not believe it's an investment, because like him, as he said to me, earning 5% on monies on a cash value account isn't an investment for me. You know, I take my money and I put it into businesses and I make a whole lot more than 5%. And so my friend is accurate on both accounts for why he thinks he doesn't need high cash value insurance. One, he's not in debt and doesn't need to use it to get out of debt. And two, it isn't a good investment, right? But it's a bank. In fact, it's the best bank on the planet. And as you're going to see, in 2010, the banking system, which was already fragile, got even worse. And I'm going to explain why I personally, and no one that I know that has $250,000 sitting above that in the bank, should keep their money sitting in a bank, except for, you know, the banking functions of moving money in, transferring it out, you know, using it as a checking account. But when we're talking about a bank and using it as a long-term storage place, I don't think that it's the right place to do that. So what obviously at that point in time wasn't the right time to argue with this friend of mine, so I didn't say anything. The meeting just moved on. But what I would like to say to him is there's two reasons why he should have a high cash value insurance policy. First reason that anyone with over $250,000 sitting in a bank account shouldn't keep it there is because of what happened with Dodd Frank in 2010. The FDIC was given the authority to, well, first of all, you'll recall 2008, we had the Great Recession, as they're now calling it. And that was because the banks just were stupid with our money. I think what they did was criminal, but because they legally had the right to use our money, because when we give them our money, it's their money, believe it or not. And I know a lot of people think that when you put your money in a bank, they're acting as your fiduciary. They are not. You have legally become their creditor, and they put that money on the debit on their assets and liabilities. It's a debit. And so if there's a debit there, obviously there's a creditor. You are the creditor. It's what you're giving the bank is a signature loan, for lack of a better term. You're giving them a signature loan with no collateral. And anything above $250,000, the FDIC now has the legal right to do what's called a bail-in. You see, the taxpayers were frustrated that we were on the hook for, what was it, nearly $450 billion. And the taxpayers said no. And so Dodd Frank was a response to that. And so instead of having a bailout by the taxpayers, we now have what's called a bail-in, because for whatever reason, banks are this specialty company in our world infrastructure that must be bailed out. You know, that's where you got the term too big to fail. So if you're with a big bank, don't think that it's not going to happen to you. It can happen to you, right? But because of that, they gave the FDIC the authority to take your money. I called another friend this morning and I told him what I was going to do with this presentation. And he said, they're never going to do that, Eric. I said, well, they have the legal right. He said, yeah, but they'll never do it. And you know what? I'm not a fearmonger from that standpoint, and I really hope that he is right. But the FDIC does have the explicit legal right to do this, to take your depositor funds and exchange them for equity in a failed bank. We'll talk about this specifically today. But even if the banks don't do that, just having that authority would mean I personally would never put my money in there. In fact, I went and looked yesterday to see how much my wife and I have in our two policies. It's close to $500,000. Well, I don't have that money sitting in the bank. I've got it sitting in the high cash value insurance. And I looked in our bank accounts. I was going to show these, but my wife would have a fit if I actually showed you our bank accounts even with the bank numbers blacked out. But there's less than $10,000 in the bank accounts. But in our insurance policies, we've got nearly $500,000. So, and I don't say that to brag. I say that as a way, because this friend I'm talking to has, 20 or 40 million sitting in the bank. I'm nothing compared to what he's got. And the point there is that with even the small amount of money that I might have sitting out there, I don't have it sitting in a bank. I do have it in a bank, a checking account, where I can move things in and out. And I use it for that, right? To move my money around, to buy things, but as soon as I make money, the first place it goes is into my insurance policy, right? And it sits there until I need it. And then I pull it in, I make a payment for something, and it's gone. But my money does not sit in a U.S. bank account for very long at all. I'll move it in for long enough to spend on a large ticket item. Otherwise, I keep what's needed in there to do our daily routine. So again, that I think although I personally don't trust the banking system. And I think it's going to be funny. You're going to see that even the advisors on the FDIC's committee, one of the guys, man, worth $600 million, makes a joke about it and laughs and says, the general public needs to believe in the banking system more than those of us that are right here sitting around this table, i.e. those making the decisions about, how to pull your money out of a bank account and give it to the bank to keep the bank solvent. So anyhow, let's hope and pray that that never happens. I do. But I think the real reason that people need high cash value insurance from this standpoint is for that of tax-free wealth transfer. Like many entrepreneurs, this friend of mine has worked 18-hour days for decades now just to become successful. Well, and he has said to me in the past, don't tell me that the rich do this, because they don't. Yeah, they do. That's how the Rockefellers, the Kennedys, the Morgans, the Roosevelts, that's how those family dynasties have kept their money around. In fact, there is a case study that you will see when you go and talk to many different attorneys that do estate planning. They'll tell you the difference between the Rockefellers and the Vandergrifts, because they both had, in today's money, about $600 billion back in the day. And the Vanderbilts lost that in 3 generations, basically. Whereas the Rockefellers are on what? Their 6th generation? That's 150 years. Well, you don't do that without insurance policies and trusts. Now, do I have their documentation? Of course I don't. That's what the point of a trust and insurance policy is all about. Keeping that information private, right? So that your assets are private. But you don't get to the 6th generation of wealth, 150 years of wealth, without insurance and trust. Now, I don't have the Rockefellers trust, but I do have public evidence that that's what they're doing. Why? Because of the banking system. That's right. The very system that is fragile and that can fall apart has 25 to 40% of their tier 1 capital in insurance. And that insurance is on their executives. So managers and above, big companies like Bank of America and Wells Fargo, and I'm going to show you these accounts so this isn't just, babble I'm spitting at you. This is real. I'll show you it on their accounts. But they have huge amounts of money on their managers. And they're using it for the same purposes that I'm suggesting to my friend or any of you listening to this can do. What you can do is decide what you're worth when you die. I know it sounds crazy, doesn't it? But that's what they're doing. In other words, a bank manager, what they do is, and we've seen how bank managers make tons of money, right? They get these multi-million-dollar contracts. Well, what the bank does is they buy an insurance policy on a manager. Let's say he gets it at age 50 and they figure he's going to be around till he's 65 and then he's going to live until he's 80. So they're going, okay, well, we got to pay on this thing for 30 years. Well, they figure out what those premiums are going to be. They figure out what his salary is going to be. They figure out what his pension is going to be. They figure out what all of that's going to be. And they buy a policy with a death benefit that probably ends up putting in their pockets 2 to 3x that entire chunk of money. And so when he dies, boom, they get a windfall of money, tax-free, that comes back into the bank. So they basically pay for the gentleman's or the woman's salary for the remainder of when they became a manager through when they retire, and then on into retirement in their pension plan. And that's what they're doing. And what I'm trying to say there is you can do the same thing, right? How much do I want to be worth when I pass away for my family? And again, this friend of mine that's worth millions could say, well, I've already got millions in real estate and this and that. Okay, but all those things are taxable. And so where the wealthy, the ultra wealthy use insurance is to have cash sitting there that's tax-free. So when they die, they don't have to divide up the estate amongst the grandkids, right? The cash comes in, it pays for the taxes on the estate, and they don't have to sell it in a fire sale to pay estate taxes. That's how it's used. So, but again, that's something you need to discuss with your estate planner. And if they haven't told you about how to combine trust and insurance, give me a call and I can explain that to you. But if you're not, I'm surprised, really am surprised. So what I'd like to do today is discuss first and foremost what happened with what happens with Title II of the Dodd Frank Act. What changed in 2010? We'll go in depth into that. Then what hasn't changed for 175 years, which you already know, is high cash value insurance. It's been the same. It's been around for 175 years. And then understand the Dodd Frank Act from the point of view of the FDIC and discuss bailouts and bail-ins, so you actually understand what authority the FDIC has and what risk your money might have by sitting in a bank with over $250,000 in there, and then how to transfer millions of dollars tax-free to your family. So what changed in 2010? To understand this, we have to ask the question, or answer the question, what happened in 2008? Well, obviously in 2008, some of the biggest banks in America needed money and were bailed out. Citibank, Bank of America, Wells Fargo, Goldman Sachs, Morgan Stanley, JP Morgan. All of these banks needed money. And then also a bunch of stock-based insurance companies. Don't get that confused with mutual insurance companies. Stock-based companies. AIG almost took the entire system down by itself. $182 billion bailout because they had bought so much of those risky derivatives. Hartford, Lincoln National, Ing, Transamerica, Prudential, Allstate, Ameriprise, Principal. You've heard those names by any insurance agent that's talked to you over the years, right? And they all took TARP money. So what the American public said was, look, we're tired of bailing out these insurance companies and these big, huge banks that are too big to fail, that would harm the economy if they went under. We don't want to bail them out anymore. So we need to change their behavior, as if, so that they won't do this again. But have they changed their behavior? I don't think so. Anyhow, if you haven't seen these two movies, I would suggest you go watch them. Inside Job is actually a documentary done by Sony, about, or published by Sony, about that. You'll listen to the interviewer talk to some of these men and women that were involved in this, and they're as guilty as can be. The fun one is The Big Short. That's just a Hollywood movie about three different groups that figured out that the mortgage-backed securities were about ready to fall apart, and that they bet against them, found ways to bet against them. And that's a wonderful movie. In fact, that is the reason why we had the big crash in 2008, was a subprime mortgage bubble and taxpayer bailout, and the American people say, we don't want to bail out the banks that are too big to fail. In this movie, though, there's an interesting part. There's a scene where they're in Vegas at this mortgage-backed securities meeting, and these two young men are with Brad Pitt, and the actor Brad Pitt is playing the man. His name's Raker, I believe, in the movie, but they're with him, and they're all excited because they just got this big, huge deal, and they bought a bunch of they shorted a bunch of mortgage-backed securities, and they're all excited, and they're dancing around as they're walking out of the casino, and Brad Pitt turns around and he says, chill out. And they're like, why? We just made the biggest deal of our lifetime. He goes, don't you understand what you just did? You just bet against the American economy. And then he says, and if we're right, people lose jobs, people lose homes, people lose their retirement savings, right? People lose pensions. Every 1% of unemployment that goes up, 40,000 Americans die. And these two young men just sit there quietly like, oh. And then the other major player in the movie is Mark Baum, and he's talking to a CDO manager, and when he figures out that they are bets on top of bets on top of bets on top of bets, it's when it finally dawns on him the entire world economy is in danger of the U.S. Subprime market crashing. And so my question has been for years, well, why didn't the bankers go to jail, right? If they were so reckless in their behavior as to be able to put at jeopardy not only the U.S. economy, but the world economy in and of itself, why didn't the bankers go to jail? And the bottom line is what they were doing was legal. So I asked this of Claude, an AI model, and said, why didn't the bankers go to jail? And Claude came back and said, oh, well, they're all sophisticated buyers amongst each other, so there was no fraud. And I wrote back and I said, no, my question is, why didn't the bankers, why weren't they held liable for using depositor money in such a reckless manner? And Claude said back to me, that's illegal. What they were doing was legal. And this, I think, is the craziness about this. Making loans, even stupid, reckless, subprime loans with depositor money is what commercial banks do. So that's what the problem was. When you deposit your funds in a bank, the bank owns those funds. And they can use them, as it says, to make loans or to quote unquote invest. And that since interest rates were so low, they were making more money by investing than making loans. And that's why they were doing more investing than lending. And that's what took us down. Anyhow, we look at these banks and they were quote unquote too big to fail. And so the American population said, no, we don't want this. And so Dodd Frank came along. there's the number, $443.5 billion were tied up in our money as taxpayers. And the American public said, no, we don't want to do this. So what Congress says about the Dodd Frank Act, and I'm quoting from the Congress's website right now, to promote the financial stability of the United States by improving accountability and transparency, and transparency part's going to come into play here when we listen to this FDIC meeting, because they know they've been mandated by Congress to be transparent. But when they were authorized to take money from depositors to save banks, they're worried about how much transparency to actually give out. So Congress has mandated through the Dodd Frank Act, as it bubbles down into Title II, which is the part that talks to the FDIC, transparency. Also, to end too big to fail banks and to protect the American taxpayer by ending bailouts that are paid for by the taxpayer. Again, here's the rub. Who takes the hit? The depositor, right? And to protect the consumer from abusive financial behaviors. That's what the Congress says they're going to do. And as I said, that's all part of Title II, 1 and 2 of the Recovery and Resolution Plan for failed banks. And so what we're going to listen to is an FDIC Systemic Resolution Committee meeting where they discuss their powers within Title II of Dodd-Frank and try to balance the compliance. So here's what they were given. Before Dodd-Frank, FDIC only had the authority to resolve, and that's the word they use, failing banks. Now, if you look up the term resolve on Cornell's legal website, what they point out is that to resolve is what the powers that have been given to the FDIC called OLA, or Orderly Liquidation Authority. So again, in this meeting, you're going to hear them talk about OLA. That's what it is. It's the authority that's been given to the FDIC to liquidate in an orderly fashion the following types of institutions: failing banks, failing investment banks, failing insurance companies, and what they call SIFI or SIFI, or I don't know how they pronounce it, but systemically important financial institutions. So anybody that the Secretary of Treasury and the President of the United States, in conjunction with the FDIC, decide is a systemically important financial institution, they can also liquidate those organizations. So the FDIC's Orderly Liquidation Authority covers the following. They shut down companies. They can fire executives. Obviously, the executives took them into problems. Sell off the assets of the company. Wipe out shareholder equity completely. And here's the part that I get the rub as trying to use a bank as a bank to store my wealth over time, is that unsecured creditors, depositors, those over $250,000, they are in line behind the government that gets paid off first, employees of the bank that just took you into bankruptcy second, those depositors behind that, and then the FDIC has the right to turn your deposits into stock or equity in the new bank company. That is the authority that the FDIC has been given since 2010, and that's the authority that they're going to be discussing, that, as my friend said the other day, they'll never do it. Well, like I said, listen to what they say, and you tell me if you think they're never going to do it. So the first person we're going to listen to here is a woman by the name of Susan Baker. Now, Susan is actually an employee at the FDIC. The other people are advisors, and so it's the FDIC through Susan that's requesting input from their advisors, and then we're also going to listen to their advisors. And the problem that Ms. Baker is enunciating in terms that most of us wouldn't understand, and that's what I'm trying to try to peel back today, is how do we, the FDIC, provide transparency, which the Congress has mandated, without scaring the public into pulling their money out of a bank and starting the very crashes and bank runs that we're here to try to keep from happening.
What do we want to think about today is what should we be transparent about now that would help improve confidence in the event that we're called to use our Title II authorities. And we've been thinking about this across many dimensions. First, we look at who we need to be transparent for.
That's an interesting admission. Who should we be transparent to? Which stakeholders? Maybe you and me aren't part of that group that should get transparency from the FDIC.
So the slides on the right, we've probably done more on, but what do we need to be thinking about for the stakeholders, on the general public, customers, counterparties, other people like that?
So it seems she's admitting that the banking side of the house is getting good information, but what the side they haven't worked on that well is the transparency for the general public, right? That's interesting.
We think about what message do these stakeholders need to hear, and it might not all be the same. And then we think about when we need to be transparent.
So we also have the question of when should we be transparent? We might decide to be transparent with the general public, but not until after we've used our authorities that most don't know about. I don't know.
Next slide, please. What are the things that would be helpful to get out in the public domain to improve confidence now?
So when Susan just said now, I began to think, well, why was now important? So I went back to Claude and I asked, what was taking place in November of 2022 that may have made confidence important now? I was surprised by the answer. It said, tracing regulatory warnings preceding the banking crisis collapse. Yes, extremely significant timing. What the FTC knew in November of 2022. Fed surveillance reports in June of 2022 had identified SVB as having the highest levels of unrealized losses. SVB was placed on a systemic holding company watch list, right? And so the warning that banks might need to realize sizable losses if depositors withdrew money. Now, what happened with SVB is that one of this, again, was Silicon Valley Bank. So you've got all the techie heads there, and all of these new startups have invested with these folks. Well, one of the venture capitalist companies on Thursday put out a note to some of their companies that were in their portfolio of venture capital, and they said to them, hey, we don't trust SVB any longer. Well, you know how long that information took to spread throughout Silicon Valley? 88 million tweets in 4 hours on the morning of that Friday when they went bust, which I think was like March 9th or something like that. We can go look. But 80 million tweets, and they had over $40 billion taken out. I mean, how long does it take the CFO of one of these startups that's a techie guy to grab his phone? I'm looking for my phone. He'd grab his phone and go click, 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 and pull their deposits and move them to another bank. And that's exactly what happened. And so it wasn't so much that they had unrealized losses, as we're going to see here in just a second. It was the fact that the depositors were able to pull their money so rapidly, and in less than 4 hours, $40 billion was pulled out of SVB. So by November of 2022, a supervisory letter was sent from the Fed, the FDIC, to SVB, telling them that their interest rate simulations were not reliable and questioned the effectiveness of risk management practices. Those numbers, by the end of 2022, SVB had $15+ billion in unrealized losses. In other words, 89% of their capital. Now, like I just said, those were unrealized losses. Why? Because they hadn't sold the underlying security, in this case, bonds, right? Now, as to the banking system in and of itself, $22.2 trillion in unrealized losses across the industry. 10% of banks had worse unrealized losses than SVB. And if losses alone caused failure, that's 500+ banks should have failed. Now, having read that, I thought to myself, well, what caused the losses? So I'd asked another question. So I said to Claude, what were those losses due to at SVB and the banking system at large? Because when at first I thought, well, here was SVB. They were doing stupid things like banks managers do. They get greedy. They go and invest in things that they shouldn't be investing in, or that are super risky, and it isn't just it's SVB's fault. But when I saw that the banking system at large, and 10% of the banks, think that's a huge number of banks at large, over 500 banks, should be failing, I thought, well, this is more of a systemic issue. So what caused these losses? This answer blew my mind. The losses were caused by the Federal Reserve's rapid interest rate increases in 2022. Again, that's the direct quote from Claude that Claude sent to me. What banks did in 2022, again, according to Claude, they were flooded with deposits for COVID stimulus. You remember that? Everybody was getting $600 every couple of weeks or whatever it was. And at the same time, they had zero interest rates, which meant they couldn't loan money. Okay. So what did the banks started doing? They started investing heavily in long-term bonds, 10 to 30-year treasuries, and mortgage-backed securities, not the CDOs that caused everything to crash back in 2008, just actual mortgage-backed securities, which are supposed to be some of the safest things out there, treasuries and MBS, mortgage-backed securities, right? Well, all of these were classified as held to maturity, meaning they don't get placed back out on the market. They can't be sold. So they're on the books, and they bought them again back in 2020 to 2021. They were buying these at the time at 1 to 2%, right? Well, now we're in 2022 and the interest rate is up to 4%, right? So what the Fed did in 2022 by raising rates from 0 to 4% is that was the fastest rate hike in 40 years. The damage was just simple math. When interest rates rise, existing bond values fall. That's an inverse relationship. Means is that for every 1% that the Fed hiked rates, SVB and other banks that were holding these bonds till maturity were losing 6%. So SVB had an average of 6-year duration, so a 4% rate hike was a 24% loss in value. Folks, I don't believe in coincidences like this. I cannot believe that the folks at the Fed who are raising rates from 0 to 4% did not understand who would be affected by doing this. Again, these are unrealized losses. In other words, because these were hold till maturity bonds, they couldn't sell them. But on their books, they had lost that, right? So SVB specific, 91.3 billion hold to maturity securities at cost. Again, what was cost in 2020 to 2021? 1.5% to 2%, right? Fair market value, currently at 4% would have been 76 billion. That's an unrealized loss of 15 billion. It's wiped out 89% of their capital. Again, I personally can't believe that the Fed didn't understand that this was what's going to happen. And the fact that Claude told me over 500 banks were in jeopardy of the same situation that SVB was in, and that was 10% of the banks, tells me they knew what was going on, right? So the banking system-wide, 2.2 trillion in unrealized losses. 500 plus banks technically insolvent if forced to sell. Now, most of these banks didn't have to sell their bonds, right? Because depositors weren't coming and requesting their claims, right? But those were all hidden behind the securities. So what is it that happened to SVB? Like I just said, Thursday, one of their VC that generally took their new companies to SVB Bank, one of the VC, the venture capitalists, said, hey, I don't trust SVB anymore. And how long did that take? About 80 million tweets. That's what they were back then. 80 million tweets happened in less than 4 hours, and $40 billion plus were sucked out of there, out of that bank. And so they were forced to liquidate these securities that they were supposed to hold till maturity just so that they could cover the depositors requesting their money back. That's why SVB went under. But it was all hidden from most of the banks in the banking industry because they didn't have 80 million people tweeting, hey, get your money out of SVB right now.
We're thinking about creditors. How do you communicate with claimants, including about their claims determination? How will the losses be allocated on the Dodd Frank hierarchy, which is different than under FDI Act?
So the biggest difference, as she just said, prior to 2028 and the bailout when they passed the Dodd Frank, and then post Dodd Frank, what's the big difference? Well, after Dodd Frank in 2010, who bails out the banks? Well, in prior to 2008, it was the taxpayer, and now it's the depositors or the creditors. You just heard her say the word creditors.
How, and under bankruptcy, and then how will the claimants be compensated? We're also wondering if we need to be more transparent about some of the accountability mechanisms that we have as well for the general public audience. You know, we are required to remove culpable management. How would we go about doing that?
Okay, but where are they going to get new management? They're going to appoint them. From whom? The people they know with the same banker mentality. My thoughts.
And then finally, there's the funding mechanism. You know, what part of that would be most helpful to boost confidence? I do think that the OLF and using it is the big gift. It's not a gift, but the big tool that we need. And there's a lot of questions here. And so, you know, there are a lot of things we've been thinking about, and what we want to hear from you today is what you think the priorities would be in order to go about setting expectations appropriately in public about how we would execute Title II. so that if and when we do have to have that announcement on Friday night,
This is the conundrum that Miss Susan Baker has just expressed to everybody, and she's wanting their comments. Now, she just got through saying that this is going to happen on a Friday. So I then asked Claude, well, what happens? And so Claude said, well, I'm going to look at the systemic bail-in resolution timeline so we can comprehend this, right? They call it the resolution weekend. She just got through saying that this is always going to happen on a Friday night. Okay, so what happens on Friday night? First, the FDIC announces that they have been appointed as the receiver of this bank that's failing. The bank failure is then publicly announced. Trading of the bank's securities are immediately halted and delisted, and critically, open bank subsidiaries remain open. So they don't get rid of the subsidiaries underneath that bank. During the weekend, Saturday morning, this is when the real, as it says, violence happens to unsecured creditors. This is called the resolution weekend. Okay, I thought that was an interesting word that Claude chose to use. The real violence happens to unsecured creditors. Again, remember, if you've deposited money, you're not really a depositor. You are an unsecured creditor because you've given the bank a loan. They can do with your funds as they please. Okay, so valuation is Saturday morning. The FDIC values all assets and liabilities. Think about that. In just a handful of hours, everything that the bank has is going to be evaluated by just a handful of people at the FDIC, these people that were sitting around that table there. Okay? So the FDIC values all assets and liabilities, determines the size of the losses, and calculates haircuts for each creditor class. Again, I just said it, but a creditor is a depositor. Okay? Because you have deposited money to them, you've given them a signature loan, and they're free to do with it as they please. Obviously, they've screwed that up, and that's why they're in the position they're in of failure. Bridge bank creation. So they make a new bank. Okay? The FDIC charters a new bridge financial company. In other words, a new bank. They transfer the goods, the assets, loans to subsidiaries, equity to operating companies, etc., and they transfer security liabilities only. Number 3, what's left behind in receivership? All equity. Gone, wiped out, zero. If you held stock in that company, you now have nothing. All subordinate debt, all senior unsecured debt, and most important to the people that I'm hopefully addressing in this conversation, unsecured deposits over $250,000 if losses exceed holding company capital. Think about your own company. How much money in operating money do you have inside your company? If it's over $250,000, you need to be paying attention to what's going on here. Okay, so that's what's left behind in receivership. Again, not pretty to unsecured deposits. Security for claims exchange, right? The FDIC calculates the conversion ratio. What that's saying there is if you have 10 million in your operating fund for your business and they come in and they get rid of the 250,000's gone because that's going to be, that's under FDIC insurance, right? So you now have 9,750,000 left, right? Of that, their FDIC is going to calculate the conversion rate into stock in this new bank. So you might be left with, if you're lucky, what, 4 million, 2 million, 3 million, who knows? But that's what they're going to do. They're going to calculate that ratio. They're also going to determine how much equity or debt in the new company each creditor class gets. This may issue warrants for lower priority creditors as protection against undervaluation. And then your uninsured deposits, that's everything over 250,000, might become stock in the bridge company. That's what they're busy discussing on Sunday. Okay, then Sunday evening, they're going to have new management appointed, so they're going to fire everybody that was there. They're going to have press releases draft. They're going to have a website update, and they're going to have call center staff. You figure people could be calling and asking questions on Monday morning, so they're going to do all of that on Sunday evening. Okay, Monday morning, for insured depositors, that's the people under 250,000, they're claiming it's going to be business as usual, full access to funds, and may not even notice it. Yeah, you think your company just went bankrupt and you're going to not even notice it. You'll just keep working as usual, but you'll still have your money there. So that's what happens Monday morning. Insured depositors under 250,000. But also on Monday morning, we have the uninsured depositors that have over 250,000. Pay attention to this. You wake up to find you're now a shareholder in a failed bank. Your deposit was converted to equity at whatever ratio the FDIC determined over the weekend. You had no say in it. You just bought stock in a failed company. You own worthless stock in Newco Bank or Bridge Bank. Or you get receivership certificates promising payment from whatever's left after liquidation, probably pennies on the dollar. No immediate access to your money, and you're now in line with all other unsecured creditors. Let that sink in. That's not a pretty sight. All right, the key point here. The FDIC does this entire restructuring over one weekend without your consent, without notification, without judicial oversight. You went to bed Friday evening with $5 million in deposits in your operating fund. You wake up Monday morning with $200,000 worth of stock in a failed institution, if you're lucky. As Vice Chairman Honig warned, if losses cannot be fully absorbed by the holding company's shareholders and creditors, then creditors of subsidiaries, potentially including unsecured depositors, that's you, would be subject to loss. And this is why keeping large deposits in banks is essentially making an unsecured loan to an institution that can unilaterally convert your claim to worthless equity over a single weekend. Let me ask you a serious question. They just used the example there of $5 million. How many of you entrepreneurs listening to me would give anyone on this planet a $5 million loan unsecured that they are then free to go do anything they want with, including stupid stuff like they did in 2008? How many of you would do that? Why are you doing that? Is it just because you've never been taught there's a solution that's outside of the banking system that's safer? If that's the only reason, please continue to listen and I'd love to help you out.
That people are in a position to receive it, understand it, and say, yeah, that works. And we can see how this will happen. Of course, there will be doubters, but there's a lot of things going on. So with that.
First of all, I'd like to praise the FDIC for its unrelenting pressures to have more disclosure under the actual public reports. I think they have been very helpful.
The man who is now speaking is Dr. Richard J. Harding. He is a professor of international banking and a professor of finance at the Wharton School. And he's also on the FDIC's advisory committee, and that's why he's speaking.
Second, I guess I am a bit pessimistic about your ability to communicate with the people who really need to know in terms of a crisis. And this is partly from my experience of teaching this stuff. There was a lot of interest just after the crisis. It's dwindled over time. And so people are sort of less and less interested in getting into the nitty gritty and some of the really interesting developments. So I would think your strategy ought to be to disclose as much as possible to people who professionally need to know about it. And that would certainly include the ratings agencies and the people within the banks who are responsible for these judgments. And simply have publicly available a place where people can go if they need to know more. Because we're dealing with a society where people are getting their information in tweets. There's just no patience, I think, for going through the elaborate and careful planning that has gone on. It should be there. It should be accessible when people need to know. But I don't think you have much hope of reaching a public that doesn't have a professional need to know.
Let me get this right. What Dr. Herring just said was, we will explain our Title II powers to the professional class that has a professional need to know. But to Joe Sixpack, we'll publish the truth online somewhere. It'll probably be a hard place to find online, right? So that the general public can't claim that we didn't follow our congressional mandate to be transparent. Is that what he was saying? So I asked that of Claude and asked Claude what Claude thought. And this is what Claude said. What perception management really means. The quote, it should be accessible when people need to know, but I don't think you have much hope of reaching a public that doesn't have professional need to know, is code for professional need to know equals wealthy and connected, and they'll get an advanced warning. Did any of you or your friends get an advanced warning about SVB? Remember, those knuckleheads knew about this, that the troubles they were having in June of 22. They sent them a letter in November of 22, and SVB didn't go under until the 8th or 9th of March of 23. So there was a long enough period of there for these people on these advisory boards to let their wealthy and connected friends know what's going on, right? But regular depositors, Joe Sixpack, well, we'll just keep him in the dark until, well, it's too late. Perception management is propaganda to maintain false confidence in a system that, as we've just seen, is sorely broken. Because as we just saw, who caused this problem for SVB and another 10% of the total banks out there in the United States? The Federal Reserve, by their actions. At this time, it wasn't like in 2008 where the bankers in New York were doing crazy things. This time, a regular bank that was trying to do good things couldn't get out from underneath the footprint of the Federal Reserve fast enough to not fall apart. That's crazy.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank?
The gentleman who is now speaking is Gary Cohn, again, a FDIC advisor. And as it says, he was the former director of the U.S. National Economic Council and chief economic advisor to the President of the United States. He's speaking of Trump in his first administration, right? And he's also the chief operating officer of Goldman Sachs for over 10 years. This is not a knucklehead that doesn't know what's going on in our global economy. Listen to what he says. What did he just say? I think you'd scare the public if you actually told them what's going on. If you actually tell Joe Sixpack that his small business that he's built is at risk by depositing more than $250,000 into that bank, it's at risk, you're going to scare the public. Wow.
Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim.
Here's what Claude had to say about that insurance company comparison, right? It says, when you say my insurance company doesn't tell me, and by the way, he's talking about like a house mortgage insurance or auto insurance, right? When my insurance company doesn't tell me what they're doing with my assets, they'll just assume they're going to pay my claim. This is a false analogy because your insurance company isn't legally authorized to take your premium payments to bail itself out. Banks under the Dodd Frank are legally authorized to convert your deposits above $250,000 into equity in a failing institution. You become an unsecured creditor. We've talked about that many times. In 2010, you just weren't told about it. Let that sink in. He knows this, but you don't. Why? Don't you have a CPA that's told you this? What about your CFO? Your financial advisors? Have any of them told you what's at risk in your small to medium business because you've got money sitting out here? I love this next part. He's going to giggle at us.
Right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do.
Ha, ha, ha. What a sick admission that was, right? I mean, we in the industry that know this industry inside and out have less faith and confidence in the system that we're convincing Joe Sixpack, who busted his butt to create an automobile repair shop or whatever, and he's got more than $250,000 in his bank account, or he's a roofing contractor and he's got more than $250 in his bank account, or she's built her own real estate company, she's got more than $250,000 sitting in her bank account. All of these people have more faith and confidence in the banking system than the very advisory committee at the FDIC. Why? Because the FDIC knows how fragile the banking system is. And Joe Sixpack and Jane Sixpack have no clue. Isn't that a sickening admission?
That we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in. They're going to get their money out.
Here's what the AI model had to say about this. Let me look into the specific FDIC meeting and what was discussed. And by the way, I told it what the meeting was and asked it to read the transcript. It says, Eric, what they're really saying is absolutely chilling when you strip away the bureaucratic language. Let me break it down into a subtext. The explicit strategy, deliberate public ignorance. Is that you? Is that your CPA? Is that your financial advisor? When Gary Cohn, who was a former Goldman Sachs president for 10 years, by the way, Trump's National Economic Council director back in Administration 1, says, I almost think you'd scare the public if you put this out. This being the Title II powers that the FDIC has under the Dodd Frank Act, right? You would scare the public into doing what? Pulling their money out of the banking system, for heaven's sakes. The bail-in framework is real and is intended for use. Otherwise, they wouldn't be hiding it. Otherwise, they wouldn't be debating why they shouldn't let the public understand the powers that the FDIC has under the Dodd Frank Act. If people knew about it, they'd panic and pull their money out. That is the big fear, because if they do that, the whole system begins to collapse. But if you're one of my clients, you've known about this because I sent you this video, heck, years ago, right? I'm just finally analyzing it because of the conversation I had with a friend of mine the other day. Therefore, keep the public ignorant to prevent bank runs. Look, before the bank run happens, do something with a portion of your money, especially that portion that's above $250,000. Put it someplace safer. Put it someplace much safer, where you're a co-owner of that money, where it's yours, where you haven't just given a $5 million or $10 million or $20 million signature loan to a company that has the legal right to do whatever the darn well please with your money. Think about that, please.
So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people who charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
Well, there's another interesting statement. If you're rich enough to have an attorney and a large staff to go and dissect Title II of the Dodd Frank Act, well, lucky you, you're okay. You're the kind of people that need to know. Yeah, lucky you. All I am is a simple insurance agent who does this for himself. My wife and I have 2 separate policies. And no, we don't have millions. We've got $500,000 sitting in 2 separate policies with 2 separate mutual companies. But we're doing exactly this. And that's why I looked this up for my friends and family.
So I'd like to take a slightly different view.
This final speaker that you're listening to now is Margaret Meg Taylor. She seems to be a little bit, she says she wants to take a less draconian, if you will, view as they, but you're going to see she's going to say basically the same thing. We can't scare the public. We have to be careful with what we say about the powers of Title II that are embedded within the Dodd Frank Act. Listen to what she's got to say.
I do think there's more that could be put out in the public, perhaps not just on Title II, but also on Title I, in a way that isn't scary to folks. I mean, Gary, there's a timing question, right? We're at a delicate moment now. So if it goes out tomorrow, it might have a different impact than if if Susan and Betsy do their work and it goes out as we're moving out of the recession. But I'm very big on transparency. I think transparency leads to accountability. The FDIC has to have flexibility. So there are some ways that you could get out some basics, which say, we could do this, we could do that. We will be holding these folks accountable. We have these powers, we have these authorities, without putting too much out there.
So Claude answers back and says, speaking of that meeting, what they're really saying is we have a legal mechanism to seize depositor funds to stabilize failing banks. Now let's think about that for a second. Let's say I hire a law firm to create a trust for my children, and I deposit money into that trust. And that law firm goes and uses that money however they want, instead of keeping it in trust for my kids. What happens to that law firm? Every one of those lawyers is automatically disbarred, and they get criminal charges. What about a real estate agent? You ever gone to a real estate agent and given her a check for an escrow account, right? So that you can put a hold on a property that you want to buy? What if that real estate agent goes and uses that money, or she and her broker go use it however they want, right? What ends up happening? They both lose their licenses and they go to jail for 20 years for embezzlement. What about a stockbroker? Let's say you've got your money sitting in Les Schwab, right? And those are your funds, and you're thinking, well, I'm going to invest them in NVIDIA. And Schwab says, nah, NVIDIA's old school. Let's go with crypto. And they use your money. Guess what? FINRA and the SEC are going to come down on them. They're going to be permanently barred from ever working with anybody in the financial world again, and they'll get 20 to 25 years in federal prison. But what happens when a bank does the same thing? You're a client. You deposit your money. The bank uses your money then on stupid things like derivatives, and they fall apart. They go running to the FDIC. The FDIC then confiscates your deposits on Friday afternoon, as we just saw. Monday, you wake up to find that the FDIC has given you 30% of your deposits in stock in the new bank company, if you're lucky. Think how crazy that really is, because that's exactly what's happening. I said to myself, what other industry could do this? Let's assume that I take my car to Joe's Auto Repair, my truck. I've got a $45,000 truck, and I take it in for a $500 repair. And that weekend, Joe blows all of his money on crypto, right? He loses everything he owns. So he goes running to the DMV, and he says, hey man, I've got this guy's truck. Can you guys give me the title to his truck? And the DMV says, sure, you can have Eric's truck, and we'll give Eric 2% equity in your new auto company, auto repair shop. Think about that. Isn't that crazy? That's exactly what's happening here. And by the way, I chose those numbers on purpose, right? Let's say you've deposited $450,000 for a year, not a weekend, in a bank, so that you can make $5,000 in interest, or $4.5 million, so that you make $50,000 in interest, and you have to put your money in that bank at risk for over a year. And then that bank goes and they blow that money on crypto. They lose everything. They go running back to the FDIC, and they say, save us. And the FDIC says, sure, we'll take Eric's deposits of 4.5 million, and we'll give them to you to save you because you're a precious bank. And we'll give Eric of his deposits 30% of that, and we'll give him stock in your new company. Well, what happens, as I just said, let's say you aren't the owner, the entrepreneur. You're just an employee working at a small to medium business. And your boss finds out on Monday morning that the money they had in your company for whatever operations and such is all gone. It's been turned into stock in a failed bank in your area. What are you going to do? That's what they have the power to do. That's what they've argued about. Crazy, man. It goes on. If people knew about this mechanism of bail-in, they'd protect themselves. How? By removing their money from the banking system. And if they did remove their money from the banking system, then that could cause the whole banking system to crumble. And I like how Claude ended this by saying, this is not a conspiracy theory. When they, the FDIC, are saying this out loud in a recorded public meeting, it's just that nobody is supposed to be paying attention. You're welcome. I'm paying attention. So I asked the Claude, I said, are high cash value or cash accumulation accounts, as the IRS calls them, with mutually insured insurance companies, right, less of a risk than when talking about excesses of $250,000 deposited into a bank? And here's what Claude said. Yes. And this is a sophisticated wealth protection strategy that most people completely miss. Again, to my dear friend who said, I don't need this because I can pay cash for everything. It isn't about borrowing from that fund. It's about protecting your wealth that if you've got it in a bank, they can take. And if you're saying, well, I've got it in stock market, I've got it in something else, that's still risky. And again, how much do the banks have? 25 to 40% of their liquid assets. That's all I'm saying. Okay, now let's talk about banking. So where do the strongest banks in the world and the U.S. economy trust vast sums of their money? And the U.S. General Accounting Office found that 58 U.S. banks have over 40% of their Tier 1 capital in BOLI, bank-owned life insurance. And 467 U.S. banks have over 25% of their Tier 1 capital in bank-owned life insurance. And you can see there that I'm on the FDIC website right there. And here's what on their assets and liabilities page it says. You'll notice, and if anybody's ever been to a downtown area in any major city in the United States, what have you found? Well, the biggest buildings happen to be owned by the banks. And so it's no surprise that banks have a lot of real estate. So if we look at the real estate holdings of Wells Fargo, they have between, and this was from 2017 to 2018, they went from 8.5 billion to 8.5 billion in value. Now, for those of you that have got policies with me and understand this stuff, you know I made this thing, 5-10 years ago. So you've seen this for a long time, and I haven't updated, but I doubt it's going to change. Again, the point is made. If you go a little bit further, again, down on the asset column, you're going to see where it says life insurance assets. Note again that life insurance assets are considered an asset. And would you believe that Wells Fargo has $18 billion in life insurance cash value? And they've only got $8 billion in real estate? Think about that. All that real estate right there. That real estate only comes to $8 billion. Yet they have twice that much in life insurance. Well, let's go look at what happens with Bank of America. Again, properties, 8-9 billion, and assets for insurance, 22 billion. So here's something else I want you to think about. This is their cash value. In other words, this is surrender cash value. And that's why it's considered tier 1 cash. Because if Wells Fargo or Bank of America needed access to cash, they can get this cash immediately. They just go to the insurance company that's with, and they say, give me $1 billion. And they have to give up $1 billion right then. That's why it's considered tier 1, because it's readily available cash. But it's still an insurance policy, and the death benefit is going to be probably about 5x greater than the cash value portion. So what you're looking at combined is about $100 billion in death benefit. So if you've ever wondered why it is that bankers, that you hear about these exorbitant salaries where they're making, 20, 30, $50 million a year, that's why. Because the bank isn't worried about that money. They know they're going to recoup it because obviously Sally, the CFO, is going to die some point and they're going to get it all back. So why did I just tell you that? Because every one of us can take that concept and put it into our own lives. Finishing up what Claude had to say. What this meeting really reveals is this. One, the FDIC, knew a crisis was coming 3 months in advance. Did you hear about it? Did anybody warn you if you were at SVB Bank? They were planning how to implement bail-ins by keeping the public calm. Again, if bail-ins weren't something that they really had the ability to do and were contemplating doing it, they wouldn't have been debating that. They explicitly discussed not educating depositors to avoid bank runs, and the system is far more fragile than the public is told. This is why, and it's talking to me, Eric, your focus on whole life insurance with mutual companies is literally outside the banking system framework, no FDIC insurance, and no bail-in provisions. And I get asked this all the time. Well, why would you put your money with an insurance company? Is that safer? Yes, it is, because they don't gamble with your money, right? Why? Because they're not allowed to do any of the fractional reserve shenanigans that banks are able to do. What the FDIC members were saying in that meeting was basically the public needs to keep trusting in banks that we know are fragile, because if they don't, the whole system collapses. And that right there was stated categorically when Gary began to chuckle. The public trusts the banking system more than us. No kidding, because you know the ins and outs and the truth, and you're hiding the truth from the public, right? The real context and why that meeting in November of 2022 is of importance is because the FDI insured institutions had at that point over $482 billion in unrealized losses. That's 10 times more than what happened and caused the 2008 Great Recession. Now, this is the part that I think is important for those of you that are thinking of doing this as a bank. You know, when your teacher pounded on the podium and said, this is going to be on the test. This, I think, is what's really important from a banking standpoint of storing your wealth. The FDIC only had $125 billion to cover $9 trillion. There is no logical way to say something with 1.39% reserves is stronger than something with 100% reserves. Now, I want to talk about the 100% reserves there, and this is why this becomes so important. And I'm going to show this to you with my personal insurance policy. And as you can see, this is my policy. I got it when I was 55, a non-smoker. Okay? There I go coughing. That's too funny. My annualized premium is $60,000 a year. And let's look at my cash surrender value here. I have $262,000 in cash surrender value. Now, I'm 60 years old, had the policy for 5 years. But I went in and looked at my actual policy today, and as of January 8th, I have $282,000. So why the discrepancy? Why do I have an extra $20,000 in my account? That's because I front load my policies. It's something I teach my clients to do. Get as much of their money in at the beginning of the year as they can of the insurance cycle. That way the insurance grows larger. So even though I'm supposed to have $262,000 at the end of this year, which would be October for me, which is when I began my policy, I have currently $282,000. So I'm well over what I'm supposed to have, an extra $20,000. But this is my death benefit, $1.26 million. So if I were to pass away today, my wife and children would get $1.26 million. When it talks about that 100% reserves, it's talking about the number right here, this $262,000. By law, statutory law in every state, insurance companies have to keep 100% reserves. And what it's talking about is the cash value right there. So when we're talking about this being a bank, and let me click through on this. So what we're talking about here is, as a bank, my deposits. This year I deposit $60,000. My deposits are going to grow to $62,229, and that includes the cost of my insurance. So at this point in year 5, when I put in $60,000, it grows by $62,000, and it pays for my death benefit. It's all taken care of. So as I said earlier, there is a negative period where you're actually, you're buying the insurance and it's not self-generating. You're still paying insurance. I'm still paying the same cost of insurance this year as I did in the beginning, but it's now taking care of that death benefit. But back to the banking side, my reserves, $60,000 that I put in grows to $62,000. And the insurance company, by statute, has to keep my cash value, or $282,000, on hand. So and I get this question all the time, well, are insurance companies safer or safe? Yes, because at least your funds that are in there, I have $282,000 in there in cash value. And if my company started going south, we know that they have the $282,000 because they're not allowed by law to risk under that amount. So they've got to keep their reserves. They have to keep available to the owners of the policy. What would be at risk if my insurance company went belly up is the death benefit, the $1.2 million in death benefit. Now, I'm not saying that part isn't important, but I'm going to be gone, so who gives a... No, I'm just kidding. But that's the part that is at risk, not your cash value. So when you're looking at this from a banking standpoint, the cash value that you've deposited is still there, and the insurance company must keep 100% reserves for that. Comparing that again to the banks that only have 1.39, and that's a misnomer because the banks don't have to have it anyhow, because that money is really the FDIC's. So literally what we're looking at, to not be deceptive, because that 1.39 is the FDIC insurance. But if we're talking about people beyond that, for loans and things that the banks have risk, they have usually 10 to 14% reserves against the amount that they have lent out there, against the debts that they owe. So you're losing at least 90% of your money just right there. Whereas with an insurance company, all of your cash value is covered statutorily by law, and they must have it, and they cannot play with it. Huge difference. Again, especially for what I'm arguing, this is the safest place to have a bank. Okay. You might think, well, this has never happened before. Well, it hasn't happened in the United States. That's true. It has happened in Cyprus. It happened in 2013. So initially, the government wanted to help bail them out, but they couldn't get any loans in the international markets. And so they were forced to just go with a bail-in. And so what ended up happening is anybody that had over 100,000 euros in the bank woke up on Monday morning to find out that they had 52.5% of it. Again, it was in their account, but if you look into the details of this, it took them 6 to 7 years before they could withdraw that amount. And then the other 47.5% was gone. It was converted into worthless bank stock. But hey, the politicians were able to tell the world, we did not bail out the banks. So who had to bail them out? The people that had deposited their money in the banks. It's just that simple. That's scary. Anyhow, politicians were happy. We began this whole conversation discussing the reason why Dodd Frank was put in place. And it's because those organizations, Citibank, Bank of America, Wells Fargo, Goldman Sachs, and by the way, Goldman Sachs is where Gary, that gentleman that was laughing at us, worked. I looked him up. His net worth right now, due to the stock he owns in Goldman Sachs, is worth about an estimated $767 million. Do you think that a guy who has that much stock in Goldman Sachs, total, still to this day, do you think he wants a bank run on the banking system? I don't think so. What I didn't show you was this slide. You see, at the exact same time all of those major organizations were going down, mutual insurance companies, and I've explained the difference, stocks Stock-based companies, the fiduciary responsibility of the executives is to the stockholders. With a mutual company, the fiduciary responsibility is to you and I, the owners of the company that have policy, so the policy owners. So organizations like Lafayette Life, Mutual Trust, Mass Mutual, Penn, Northwestern Mutual, Guardian, and by the way, I'm licensed in all but one of those, they didn't take a penny. They didn't have to take a penny. They were doing fine. In fact, Forbes wrote an article right then in 2008, December of 2008, called Mutual Respect. Here's what it said. With their survival on the line, publicly traded insurers, so the stock-based companies like AIG that we just saw, are scrambling for cash by cutting dividends and issuing new shares, thus diluting existing investors, begging regulators for a relaxation of capital requirements. In other words, as I just got through saying, the reserve requirements is to have 100% cash value available. And the AIGs of the world were saying, wait a minute, let's reduce that a little bit. No, nope. And lobbying Washington for a cut of the $700 billion Wall Street bailout. Meanwhile, the article goes on, mutual insurance companies reported double-digit growth in sales and didn't ask for a dime in bailout money. Now, that was December of 2008, right? Why didn't they need any money? Because they didn't need to fail. A little bit later, another author there at Forbes wrote this one. It was called A Financial Bunker for Scary Times. Here's what the author says. Suppose there was a financial instrument with a track record stretching back 1,400 years. Now, I don't know where he got that number from. I know they've been around for 400 years, but I didn't know it had been 1,400 years. That was so solid it could survive the Great Depression intact, that earned untaxed interest at a competitive rate, and could be borrowed against at will, regardless of your credit condition, and that could be used by individuals as well as major corporations. We just saw that. The banks, Walmart, many other companies use it, and banks as a safe harbor during economic turmoil. You'd call it a financial bunker for scary times. And you'd be talking about mutual whole life insurance. Again, to my friend that has millions and wants to send it down to his children, and then their children, and then their children. The point is this. During the next 100 years, do you really think the banking system is going to be safer than the insurance system that's already proven with all of these organizations that I just listed a minute ago? They've all been in business about 125 years or more and never had a single year where they didn't pay out a dividend. The article continues. Mutual whole life is the kind of insurance our parents and grandparents owned in the good old days, before the stock market began to boom in the 1980s and 90s, and most people changed their focus. That's what he's hinting there. Their focus from insurance protecting their wealth to what we were being told by the banks that we needed to do through them, which was to invest in the stock market. All right, so let's recap some of the things we've heard today. It only earns 5%. Yeah, I know. It isn't an investment. It's wealth preservation. But if you look at something like the S&P 500 that you pay financial advisors fees on and you pay taxes on, and they tell you it made 9% over the last 30 years, guess what? When you add in taxes and broker fees, it takes it down to about 5%. So one's risky, one grows tax-free, and it isn't risky. So they'll never do bail-ins. Okay, I sure hope that that's the truth. But they have the power to do it. That's like saying the military has guns and they'll never use them, right? They have the legal authority to take your money. Why risk it? Put it someplace where they can't, where you own it. I don't need insurance. Okay, neither do the banks, but they've got $200 billion of life insurance on their executives. Why? Oh, and by the way, Gary, the guy that you heard laugh at us, his company, when he became president, they had never owned insurance before on their executives. And I looked up their SEC filings. Guess when they started using insurance for their executive team? 2006, when he became president. And they filed for the next however many years. So I did look that up, by the way. How about this one, my favorite? Banks are safe. Okay, think about this. The year 2000, there were 8,300 banks in America. In the year 2025, 4,700 banks. That's a 43% reduction in the banks in 25 years. Now, most of those were mergers that were forced mergers because the bank was failing, and so you never heard about it because they got bought out by a bigger company. But 571 of those were failures in just the last 25 years. But go look this up. How many mutual companies have failed in the last 250 years? Just one. It had been around 146 years, and it failed in 1991 because it abandoned mutual life principles of non-risky stuff. It started getting into stocks and things, and it crashed for the same reason that stock companies crash. So bottom line is, I can help you with this stuff. Give me a holler. You got my number right there. Or go to my website, get on there and set an appointment. Love to help you out. We can help you and your family protect what's yours and pass it on for generations to come. Look forward to serving you. Thanks.